at the Singapore markets, where the STI is sliding 0.2%, bucking the trend in much of the Asia-Pacific region. Now, this is dragged by shares of the banking stocks, and these are some of the benchmark heavyweights, DBS, OCBC, and UOB, all sitting lower in trade this morning after a strong run-up in the past few sessions, taking a bit of a breather now. We want insight, so let's bring in Kian Soon. He's CEO and fund manager at Astral Asset Management, and he's joining us from Singapore. So, Kian Soon, we have SG, Singapore banks doing pretty well because of, the expectations of rising interest rates and a strong recovery in the Lion City. And we also have the U.S. counterparts starting to report their earnings tomorrow, kicking off the U.S. earnings season. How do you think Singapore banking shares are expected to fare for the rest of the year?
I think the banking shares have a good run so far. And as you have highlighted, all the positive factors, right? With a rising interest rate environment, net interest income is going to rise. The spread is favorable for banks. And as far as this region is concerned, the banks have no exposures to non-performing loans like what we have seen in China, as well as a good economic recovery for Singapore. So all these factors pose well for Singapore banks in the coming year.
How do you think that will affect the overall performance of the Singapore markets, given how heavily we're weighted towards the financial stocks?
As we can see, last year the market's STI raised around 10%. I would say more than half of it is contributed by the three banks, given that they are strong constituents of the STI. The market has recovered 10% last year, and I think all eyes will be looking at how the market will perform in this coming year, 2022, especially in sectors that are used to be previously much more affected, like sectors in the retail, consumers, hospitality, etc. So all eyes will be looking at the other sectors as we continue to embark on the path of recovery in Singapore.
Kian Soon, can you look at China for us? I mean, we see how in the US the screws are tightening for monetary policy. In China, it is loosening, and that is propping up some of the investor sentiment on hopes of policy support. On top of that, we see these cheap valuations attracting investors. Is it too early to call a bottom, or do you think it's worthwhile taking a look at those Chinese shares?
If you look at the economic slowdown in the second half of 2021, I think there's definitely room for monetary and fiscal policies loosening. In China, basically, they are worried about this slowdown. And for the coming year, I think the Chinese government will be ensuring that they achieve at least around 5% of economic growth so that the unemployment issues as well as other economic issues could be addressed. And this is a critical year for China. So I would see that the Chinese government will continue to announce good plans, economic revival, as well as policies to help to boost the Chinese economy. At the same time, I would say that from a value perspective, the Chinese markets and the Hong Kong markets offers a lot of value stocks, like you mentioned, and this actually will augur well for investors who is looking for safety of margins in terms of trading.
I see among the key risks that you've highlighted, including the slowing in China and the inflationary risks, something also we are looking at is Fed action. And we know how even if they turn the screws on monetary policy settings, it's not going to fix the supply side problems. It's going to perhaps do something to demand. So the hands for the US central bank seem to be tied pretty much. What is that going to mean for the rest of Asia, given how inflation is continuing to keep at those levels in the US?
So if you see the US markets have actually outperformed and delivering double-digit returns for the past 3 years, I think what I wish to highlight is investors shouldn't be complacent and expect 2022 will be the same. Reason being, inflation, interest rate rise will be a key issue that the investors and the markets will have to cope with. As for Asia, as you see inflationary pressures in the US and prices rising, I don't think we're going to be spared. It all depends on the kind of fiscal tools that the various governments could employ in terms of coping with this rising costs and in terms of helping the population to cope with this problem. So it's going to be an interesting problem because in Asia, a lot of business, especially those that would not be able to transfer the rising costs to their customers, will actually face declining profits. While we are optimistic about strong businesses that have pricing power, because these businesses ultimately will be able to transfer the rising costs in terms of raw materials, labor costs, etc., to their customers and should do very well in the coming year.
Right. Look towards companies with pricing power as these inflationary pressures accelerate. Kian Soon, thank you very much for your analysis. Kian Soon of Astral Asset Management. Well, that's your business update for now. Julie, back to you.
April, thank you very much. And before we leave you, here's a look at some of the other stories we're tracking for you on CNA Digital.